What is going on, guys? Today's video is going to be about high implied volatility and high premium collection. These are the two biggest and most important things for collecting a lot of money, especially if you're going to be running selling strategies using options like your friend and your uncle Henry right here. So I'm going to show you how to make as much money possible selling options. Now, specifically, why this is so important is that selling is much more profitable than buying options. This is the research that I came across when I was working at Goldman Sachs and two different hedge funds. Now, I know most beginners are looking to buy options. However, selling options is way better. Now, you want to make sure that you're selling options on stocks that have high IV, and that's going to mean that it's going to have high premiums, which means more money in your pocket. Now, implied volatility is directly correlated to premium. So I'm so excited to show you guys exactly how I go about this process. I'm going to show you a couple different things. I'm also going to go over a lot of my stocks in my watch list and basically give you a cheat sheet on stocks that you can run many different strategies on, whether you're doing covered calls or selling puts or put credit spreads or any option strategy. I'm going to show you the best stocks that have high IV and how I check for that and how I think about this whole process. Now let's go into a stock. I'll pick Tesla right now. I have a big Tesla position and I'm running a whole lot of different option strategies right now. I'm currently up $35,800 on 5 different strategies on a whole lot of collateral, but I'm just going to click trade Tesla options and I'm going to show you the difference that high implied volatility makes on a stock like Tesla versus others. And who knows, maybe later in this video I'm going to find stocks that are better than Tesla, because I'm not married to Tesla, right? I just want to make you guys as much money as possible and show you all of the possibilities. So I'm certain I'm going to show you some options that are going to be better than this one I'm going to look at right now. But if I open up the 920, you will see that a few different factors that I look at is this implied volatility right here. I'll tell you a little bit more about it in just a second. And implied volatility actually impacts Vega. So Vega measures how sensitive the option is to implied volatility. Essentially, it tells you how much the option is going to inflate given more volatility. By the way, I would really appreciate if you inflate that like button for me. I also do have a free leap video in the description with a few different leap options that I'm picking for 2022. That's a free video in my description that you can click. You see that I'm going to be asking for your email, but that's because I want to be email buddies and send you some ideas or cool things that I create in the future. Now with this Tesla example, I want to show you how much money you can collect even if you're not running Tesla. I'm going to show you a small account trading strategy as well. I'm going to go through the whole gambit of things that you can do given high implied volatility and how that's going to help you. So first of all, 79% implied volatility and Vega is 0.34. Now what Vega is saying right here, this 0.34 is if implied volatility increases, then Vega is going to increase by 0.34. So similar to Delta, say the option goes up by $1. Well, the Delta right here says 0.47, which means that the option is going to rise by 47 cents. Now Vega is saying something similar to Delta, except it's not measuring the movement of the stock going up or down, it's measuring the implied volatility. So a 1% implied volatility move is going to move the option by 34 cents. Now, what I'm going to do is take this $25 right here and divide it by $920. The reason why I'm doing this is I want to see how much premium you can collect if you were selling a covered call option for basically at the money for the strike price. I've changed this to sell call option, and the amount of premium that I'm collecting in just 3 days is 2.7%. So 2.7% in a single week is going to be over 10% in a month, and obviously that's going to be over 100% in a year. So selling strategies are fantastic, but now that's a selling strategy on Tesla. Can I find a stock that has better options than Tesla? And what does this look like for safer stocks? So for example, I'm going to show you covered call on Coca-Cola. I know this isn't the sexiest strategy in the world, but I just want to show you guys the difference between Tesla, Coca-Cola, and then I want to go through a few different stocks and show you which ones are my favorite. Now for Coca-Cola, I'm going to go trade Coke options. I'm still going to go for February 4th. I'm going to click sell call this time. And I'm going to sell an at the money option. Now I'm not going to execute this. I just want to do the math for you guys. Now taking the $25 premium and dividing it by basically $6,100, which is how much you would need to put up for a covered call. Again, if you don't have that capital, I'm going to show you examples on like Palantir, HIMS, and a whole bunch of different stocks that are way cheaper. So don't worry about this. This is just educational. I want you guys to fully understand how to make as much green in your pocket as possible. $25 divided by 6,100 is 0.004 4%, okay? It's not even half of 1%. Now, if I expand the $61 strike option right here, you will see a few different things. Now, the implied volatility is 20. 20 is basically like 1/4 of Tesla. Tesla was around 76. Coke is around 20. In fact, it's below 20 right now. So 1/4 of Tesla. And this means that it's way less profitable to sell covered call options on something boring like Coca-Cola. And look at that Vega. That Vega is 0.02, whereas the Vega was like 0.34 for Tesla. Now let's go into my portfolio and look at a few different things. Now, I do want to mention that I like free resources like Yahoo Finance. I do get some ideas from Yahoo Finance. Some of the things that I honestly do look out for, and I just typed in Yahoo Finance /screener. What I do look out for is I like to look for stocks that are most shorted, because really high short interest stocks usually have some type of issues, or they're just really popular on the internet, which means that typically they have higher implied volatility. Now, I also really like growth technology stocks, and that's the reason why I have Tesla, Palantir, and so many other stocks like SoFi. I'm looking at stocks that have high earnings growth, essentially in excess of 25%. Typically, it's like even 40 or 50% like a Tesla, because these stocks not only are high growth, but they also have so much implied volatility, which translates into high premium. So whether I'm selling put options, which is great strategy to get into stocks for cheaper than they are trading for. I'll also have a video for you guys in the description on selling put options. That's pretty much one of my favorite strategies. But if you have a small portfolio, then you can do something called put credit spreads. Spreads require way less capital. I still love to sell put credit spreads on growth and technology stocks. I like looking at most active stocks. I also like looking at aggressive small cap stocks. However, there's a trade-off with small cap stocks that I'm going to reveal to you. It's not best to trade options on aggressive small cap stocks. I'm going to get into that in just a second. But essentially, I look at a lot of different things. I don't look for conservative plays because, again, conservative stocks are not going to have as much movement. Now, let's take a look at my portfolio. I want to show you guys some of the different things I'm running on. By the way, I'm having really good success on doing put credit spreads on like Facebook, Alibaba. I just opened this up yesterday in Discord. So obviously the Discord is a fantastic place to just follow along and have a done for you solution for trading options, because I basically say everything that I do, and I have live coaching Mondays and Wednesdays. So there's also an application for that in the description. Coinbase is something that I'm trading. Lucid has made really good money. Net, Nvidia, Iron Condor, Snow. I've been selling some SPY puts just to protect my portfolio with this whole market correction going on, and it's made $2,000. But let's go down to some smaller cap stocks, because I know some of you guys have smaller portfolios, want to understand how you can make consistent money on high implied volatility stocks that are cheaper. So HIMS is a good example. It's currently trading for $4.81. So I'm going to trade HIMS options. Now I'm going to take a look at a few different factors and show you what I'm going to be looking at. So if you notice here, HIMS has February 18th and it doesn't have February 4th. That's one of the downsides with smaller cap aggressive stocks, is they don't have the best expiration dates. Most of them have monthly options. Now, I'm not against monthly options. I think monthly options are fantastic in some cases, like maybe for HIMS, we're going to take a look in just a second. But for many stocks, it's not going to be good, because some of these options are not only going to have bad expiration dates, they're also going to be illiquid. So let me show you what that means. So when I expand this option right here, HIMS is actually decent. The bid is 0.25 and the ask is 0.35. However, you're going to see when I pull up some other stocks that this bid ask spread may be much wider. Now, when it's much wider, that is not a good thing, because you're actually losing money when you're trading. Now, for Apple, the bid might be like $1 and the ask might be $1.01, which is fantastic. That means the bid is tight. So if you just take one thing away from this video, is that you want to trade things that have tight bid-ask spreads that are very close to each other, because that way it's more liquid and it's better for you. Now, another thing that I do look at is the volume. The volume is only 10 for HIMS, whereas for Tesla, it's probably in the thousands. So this is not a generally good thing, because lower volume means that you're not going to get the best price. However, the implied volatility is even higher than Tesla. So in fact, I actually found an option that is better than Tesla based on implied volatility. Now, the Vega is super low, but one thing that I'm realizing is the reason that Vega is so low is because the price of the option is so small. Right here, it's 30 cents, and the price of the stock is $4.84. So this Vega Vega is actually pretty good considering if we multiply HIMS by like 100, we're still not going to be at the price that Tesla is. So basically, this is a very good Vega. It just depends as a ratio of the price of the stock. Now, you don't have to do the ratio. You don't have to do all this complicated stuff. All you really need to look for is this high implied volatility, because this implied volatility actually gives you all the information. You don't necessarily need Vega because implied volatility and Vega are both correlated. They're both pretty much the same thing, and they're measuring the same thing in the option. Now, looking at the option, it's 30 cents. So 33 cents, which is really $33 for each covered call in this example, because each option is 100 shares, $33 divided by $500 is 6.6%. So you're getting a 6.6% return in less than 3 weeks on HIMS, and you still get upside on the stock. It's currently trading for $4.83, and this strike price is $5. So covered calls are fantastic. However, I'm going to show you how I'm also making money on coin, on net, on Nvidia. Now, specifically, I love Nvidia because it also has really good high implied volatility. I'm going to show you a strategy that I'm running on Nvidia. Now, this strategy is called an iron condor, and I'm running this strategy currently, making $60 or about $57 right here. And I have sold 3 iron condors. So high implied volatility still benefits any selling strategy, whether you're doing an iron condor, a put credit spread, or any general selling strategy. So now if I take a look at sell call option and I click $245, this is a beautiful option, guys. It's beautiful. Now, you probably already know, or you could probably tell what I'm looking at, but the first thing that I see is awesome volume. Amazing. 15,000 volume. That is bonkers. That means you have a lot of liquidity. And in fact, as I'm talking here, it continues to rise to 15,453. Now, also, the implied volatility is very healthy. You may be wondering, hey, well, what is a good volatility, Uncle Henry? Is it 70? Is it 100? Is it, what is it? Well, I actually believe anything over 50 is good high implied volatility. So currently Nvidia is at 70, which means it's near Tesla-like volatility. Again, if you remember, Coca-Cola was at like 19. So this is 3.5 times more volatile than Coca-Cola, which means there's more action, it's more fun, and you can collect more green into your pocket. Now look at the bid-ask spread. The bid-ask spread is pretty tight. It's only 0.15. However, if you notice here, this option is way more expensive. You're actually going to collect $535, and the bid-ask spread is only 10, which is really small as a ratio of how much you're collecting. Now, $10 is a lot if you're only collecting $30 like we saw on HIMS, but $10 is not much at all if you compare it to the premium of $500. So now I'm going to show you a put credit spread, which is one of my very favorite strategies. I'm going to scroll down and I'm going to pick something like the 215 put option. If I click this right here and I expand it, see that the volatility is 0.83. Fantastic. Now I'm going to buy the next leg lower, which is the 212.5 put option. And you can see right here that I'm collecting $11. Now this might not be a lot of money. However, something that you're going to notice is I'm only putting up a couple $100. I'm putting up $200 to make $11, but this is expiring on February 4th, 3 days away, and the price is completely far away from the current share price. The only reason why I'm still collecting $12, which isn't that bad, for just $200 worth of risk, which is actually a 5% return in just 3 days, even better than the Tesla trade, is because of high implied volatility. High implied volatility means that these premiums are so inflated. They're so high that you can actually go way out of the money, down to $215 on Nvidia, and still make decent money on a put credit spread, $12 on just a couple $100, and that's all because of the high implied volatility here that you're seeing of 83%. So if there's one takeaway, find stocks with high implied volatility. However, make sure that they're a little bit bigger. Make sure that they have good liquidity, which means good volume, good open interest, and pay attention to the bid-ask spread. If you want all of this done for you and for me to hand select all the options that I'm trading and show you how I've been successful trading options for almost a decade, I'm 9 years in, then make sure you apply for a free call and talk to someone on my team about joining the Discord channel where you can see all of my trades and have my coaching on Mondays and Wednesdays. Thanks for watching. I hope that February is a super successful month for you, and I hope that you guys kill it with this premium out here. Uncle Henry, peace and out.